One of the most hotly contested ideas right now is student loan refinancing, which would simply allow student borrowers to refinance their student loans, just like car owners can, homeowners can, and small business owners can. To understand how refinancing helps borrowers, let's imagine a prospective homebuyer all the way back in July of 2007, right before the collapse of the housing market. This homeowner took out a garden variety 30-year fixed-rate mortgage at a time when interest rates hovered around 6.7%. Now fast forward a few years. Assuming this homeowner came out of the recession with his mortgage intact, he would have come out from under the recession staring at historically low interest rates around 3.8%. Refinancing his home would save hundreds a month and potentially tens of thousands of dollars over the life of the loan. Now contrast this with an individual who went to college around the same time. This student took out an average of $25,000 in federal unsubsidized loans at 6.8% interest rates to cover tuition and living expenses. After school, the 6 months grace period when she didn't have to pay student loans and maybe a forbearance to allow her some wiggle room, she finally begins paying off that loan, which is ballooned by several $1,000s. On a standard 10-year plan, she's paying around $38,000 total on the original $25,000 balance. Around the time when she starts repaying in 2013, Congress strikes a deal on student loan interest rates, pegging them at 3.86% rather than 6.8% that this student was paying. But instead of being able to take advantage of this, she's locked into her rate no matter how similar her profile is to students who are entering college at that time. Sure, she can take advantage of one of several different income-based repayment options to help with monthly payments, but even if she does that, she's still likely to see the total amount she pays over the life of the loan increase by the thousands. If she had been able to refinance her student loans, her monthly payment would drop, but more critically, she'd actually save several $1,000s over the life of the loan. And this isn't some new program, she'd simply be taking advantage of current interest rates. And doing that would cut her total loan payments by about 12%. Now, of course, we need to lower the cost of college. We need to increase state investment in higher education, and we need to return to a system where debt-free college is the norm. Basically, we need to make it so that there are fewer student loan borrowers out there. But there are a lot of struggling loan borrowers out there, and helping them refinance their student loans would be a great first step.